Welcome to the Defenders of Business Value, the podcast that helps business owners unlock the value they've built and exit on their terms. I'm your host, Ed Mysogland, and for the last 30 years, I've been helping business owners prepare, grow, protect, and ultimately sell their businesses. Whether you're a business owner, a buyer, or an advisor guiding others through the process, if you want to make your last deal your best one, you are in the right place. So let's get started. All right, welcome to another episode of Defenders of Business Value. We are going to be talking about everyone's favorite episode. And after 140 episodes, what we found is these particular episodes seem to resonate the most because they're packed with so much information. And today we're going to talk about market data. What's going on in the market? All the 2025 results are in, and all of the marketplaces have shared their findings, and that this is what we're going to do for today's episode. So for those of you who are not on YouTube, I'll have a link to all of the data that we're sharing here. And for those of you on YouTube, you'll be able to see the PowerPoint presentation. So let's start with BizBuySell. And the big word for right now is stabilization. According to BizBuySell, the volatile swings in the last few years have leveled off. Transaction volumes remained flat while sale prices ticked up 2% annually. So let me share with you that the median sale price is $350,000, which is 2% up annually. And the value of these transactions is approximately almost $8 billion, which is a 3% increase. Now, if you're a nerd like me, you're sitting here saying, well, inflation rose substantially higher, so technically business value did not keep pace. Having said that, I don't think it's necessarily anything to be terribly concerned about. But again, back to the backdrop of stabilization. Under the surface, we're seeing a real complex story unfold, and you can see there's a K-shaped sector divide, right? What does that mean? I'll describe it. On the top side of the K, we're talking about service businesses, and those service businesses are up about 4%, the total number of transactions, and the median sale price is up about 5%. In the middle of the K is retail. And what we find with retail is that retail was flat. They lost about 2%. And the median sale price, like I said, was 2%. They did not grow at all. So now as we continue through this, on the bottom side is manufacturing. And it's no secret to anybody that is following manufacturing. The tariffs wreaked havoc on manufacturing, right? And I can tell you in our practice, we'd lost at least 2 or 3 deals that, the business owner had to go back to the drawing board because the value just evaporated as a result of the tariffs. And again, it is what it is. We'll see how that shakes out going forward. Now, the offsetting thing to the tariffs, especially with manufacturing, is that the SBA increased the availability of capital. They used to cap out at $5 million. Now it's $10 million. So manufacturing companies can go out, get expansion loans for equipment as well as other acquisitions. So again, all's not lost in manufacturing. It's just I'm looking at it as a reset. But I can tell you that our manufacturing buyers are actively seeking opportunities to grow through acquisition. All right, this next one is the new buyer and AI influence. So what the report calls corporate refugees. 44% of today's buyers identify themselves as corporate refugees, professionals leaving traditional jobs to buy small businesses. And that's where things get really interesting. AI is a major driver of this trend. 33% of the buyers view businesses using AI as significantly more valuable and scalable. So for me, and where we sit in the sale world, I have not seen that translate to more valuable businesses. Maybe the business buyer is identifying and looking at opportunities not to pay for the value, but I have not seen those businesses that have AI as seen more valuable. I think technology is just moving at a pace that you have to have some time in order for the earnings to translate to value. What I am seeing, though, is automation and robotics, CapEx, right? Things that you can touch and feel and see. I can tell you we have a couple transactions, especially one in the manufacturing, where the installation of a robot is getting the business an additional turn on their EBITDA. So AI is here to stay. I think everybody's kind of interested in what does it look like a few years from now after the dust has settled, if it ever settles. So now we have to talk about money, right? So big money is entering Main Street. So we're seeing a lot of private equity firms are chasing small business add-ons. Let's talk about interest rates. What's interesting from the BizBuySell report is that 71% of brokers indicate that interest rates cuts have not noticeably impacted buyer behavior. And I would say in our practice, we've noticed that too, that it's kind of business as usual. Cost of capital is fairly the same. The risk of variable rates going up has dissipated. So I think the buyers are looking at their cost of capital, that it's only going to improve the debt coverage service going forward. So that's kind of what we're seeing there. Now, moving forward here from the report, and this has been the same for nearly as long as I've been in the business, which is over 30 years, is that it takes time, right? It takes time to prepare a company for sale. And every business owner should anticipate that it's a 12 to 18 month window in order to prep and execute a sale from start to finish. I mean, when I say start to finish, I'm referring to sale prep, sale execution, integration with the buyer. That's kind of the window right now for what it takes to execute a sale. All right, now let's move into our next group, which is DealStats. Now, DealStats, it was really interesting here. So DealStats, the multiples, they are down, believe it or not. The EBITDA multiples over the course of the year, they're at 3.5, down from a peak of 4.8. And again, take it with a grain of salt, because I know market data will be trickling into DealStats over the course of the year. So this number may creep up a little bit, but I think generally speaking that the multiple is probably down a little bit. Next, tech, well, it's a big land grab. As you can imagine, everyone is running to tech. The question is, how do you pay for it, right? So we're running at 14.6x as the high industry, getting the most activity, to food and hospitality running at a 2.6. So you can see the difference in how that, just the multiples across the board are faring. But the big one is tech, and it's always been that way. Tech and insurance, and then the low has always been food and hospitality. So moving forward, median prices. On DealStats, median prices increased, right? They jumped from a median selling price of $350 to $400,000. Net sales have risen from roughly $750,000 to $838,000, but the EBITDA multiple for the median in 24 was 3.7 and decreased in 25 to 3.5. However, if you are selling your business, we've got some good news for you, that the down payment, everybody is always consternating about seller financing and so on and so forth. The down payment in 2024 percentage was 90% down. And then in 2025, it was 94% down. So in other words, the seller is getting 94% of their selling price on the front end. Seller financing went from 10% and 6% collectively. Now the loan payment, this is pretty interesting, that in 2024, the bank loan of the down payment was 66%. In 2025, it was 41%, which I don't want to say whether I believe that or not, because clearly that DealStats is a reputable place to get market data. I just don't see that. If anything, I see it higher than the 66%, not lower at the 41. So all good news for sellers. Okay, now we're going to move into GF data. This indicates that deal activity has slowed down a little bit. Sponsors are continuing to lean on the low end of the market, which again, your 1 to 5 million is really attractive. Not that anybody that's out looking at buying a business doesn't know that, because there is just a ton of activity of people seeking deals. But the market we're talking about here is the $1 to $25 million. So GF data tracked 118 transactions. This is a fairly small universe compared to the core market, which GF data tracks, which goes up to 500 million, which saw roughly 142 transactions. So what does that tell us? It means that small deals are claiming a greater proportional share of the market data than they did in 24. The broader market remains muted, but this segment is holding up better than expected. So this is not about value, it's about valuation. And here's where the data reveals a two-tiered market. So let's take a look here. And not that this should surprise anybody, that financing, right, that size matters. So the size premium is alive and well for deals between $1 and $10 million. The multiples average between 5.5 and 5.6 times EBITDA. However, once you step into the $10 to $25 million range, those multiples jump between 6.2 and 6.7 times. That's nearly a full turn of EBITDA just based on size. And again, for those of us that have been appraising companies for a long time or selling companies for a long time, that size does matter, and that will get you an additional turn, at least. So here's the critical insights from the strategists. All right, we're seeing a distinct split between platforms and add-ons in this sub $25 million market. Add-ons are actually trading at a premium, and compared to that is the standalone platforms. And why? It really comes down to financing. If you look at the debt coverage, the first half add-ons in the smallest tier carried debt coverage of 5.7 times EBITDA compared to that of the new platforms, which garnered only 2.3 times. So lenders are willing to finance tuck-ins through existing credit lines, but they're forcing sponsor to put up heavy equity for the new platforms. And this has created an environment that rewards add-on strategies while penalizing somewhat standalone platform creations. All right, so now let's move on to what is selling, right? Business services, especially my accounting brethren, right? There's a ton of consolidation going on in business services. So business services has solidified itself as a safe haven. It accounted for nearly half of all of the small business transactions in Q1, trading at a premium of roughly 6.2 times EBITDA. Manufacturing, on the other hand, is a split story. While the multiples are stable at 5.8, commodity manufacturers are hurting from the tariffs and the new regulatory environment. However, niche suppliers tied to reshoring are still commanding meaningful multiple premiums. So the takeaway, the arbitrage opportunity is intact at this level, but it seems as though the tuck-in small targets into the larger platforms are going to seize the day. For middle market growth, I would anticipate, as we saw in 24, that the bigger operations, the private equity groups, strategics, and just about everyone else is going to be chasing that $1 to $5 to $10 million range. So that concludes this market update. I'll have links to everything you need and everything I talked about in the show notes. And with that, we'll see you again next week. Thanks for listening to the Defenders of Business Value. If today's episode helped you think differently about building or selling a business, follow the show so you don't miss what's next. And if you want to become a more informed, confident owner, the one who knows how to grow, protect, and eventually exit at maximum value, subscribe to my newsletter. The link is in the show notes. And if you're ready to talk about your next deal, connect with me on LinkedIn. So until next time, we'll see you soon.